Great. I think we can get moving. Good morning again to everybody. For those of you who didn't hear my initial introduction, my name is Terry Solomon. I am the FinPro Practice Leader for Marsh Casualty Specialty, and I have the privilege of being your MC today. So thank you for having me. Before we start, can I just ask, for those of you who can hear me, if you can just give us a thumbs up. Just let me know that you can all hear me before I proceed. Either you can type chat, yes in the chat, or no if you can't hear me. Great, excellent. Good, thank you everyone. So we have a really great panel for you today. And we're going to be talking on the state of the market. You can see that many of us in this photo look a lot nicer in our photos. I'm having to dye my hair every couple of weeks, and you'll hear why when we go through our talks this morning, because the state of the market is indeed one of the hardest that many of us have ever had to experience. So we've really got a great panel for today. With me today is Jane March. Jane is our regional placement leader, and Jane is going to be taking us through an overview of the market from a property casualty perspective, as well as helping us with some key strategies in managing this horrendous market. I'm also going to talk a little bit around the FinPro lines, in particular financial institutions, with a bit of a focus on directors and officers liability insurance, which of course is very topical these days. Nolan Naidu, we call him Mr. Fax. He is our practice leader for forensic accounting and claims services, and he's going to give us an update on the insurer's view with respect to business interruption following COVID-19. And finally, we have Matthew Bezuidenhout. Matthew is our practice leader for advanced risk solutions in our Marsh Advisory. And Matthew's going to be talking to us a little bit about risk financing, which in the current state of the market is absolutely critical as we navigate our way into what we call Plan B. So without further ado, having introduced my panel, please, if you want to submit a question, and we do encourage you to submit questions, click on the Q&A icon in the lower left-hand corner of your screen, submit your question in the open area, and then just click submit. We are going to address the question and answers at the end of the speakers. So please go ahead throughout though, submit your questions, and we will of course attempt to answer them as best as possible. If a question is not answered during today's program, then we will ensure that someone from Marsh does get back to you and responds as soon as possible. Good, next slide please. So just to cover off the agenda very quickly, I have mentioned it. Nolan will talk on the impact of COVID claims. I will talk on financial lines and D&O. Jane will address us on property and casualty, as well as key strategies in managing the market. And Matthew will then address us on risk finance. Hopefully today's session will give you some answers to some of these really pressing questions I know that we are receiving from our clients. How should we prepare and budget for upcoming renewals, especially going into Q4 where we've seen the markets consistently harden? How has COVID-19 changed the market? And I think that's a phenomenal question, because what is insurance going to look like in the future? Very important to address that. Is COVID-19 going to bring about the peak of the hard market? I'm interested in what Jane has to say about that. What is Marsh doing to advocate for clients in the market? We'll certainly address that throughout our presentations. And insurers have been reporting high combined ratios for the years, and what impact will COVID-19 make? So these are just some of the key questions that we hope to answer in our presentation today. You most certainly can get a copy, Dudu, of the presentation once we are done. Without further ado, because we've got a lot to get through, I'm going to introduce our first speaker, and that is Nolan Naidu. Nolan, over to you.
Thank you very much, Terry. I hope nobody minds me not wearing a tie. Over the lockdown, some of us have realized that our top buttons don't close anymore. So this is as good as it's going to get for now. All right, let's get into it. Okay, generally speaking, can we go to the first slide? Thank you. Generally speaking, insurance claims become contentious for two main reasons. The first one is where there are complex circumstances around the loss and it becomes difficult to marry it to the policy wording. And the second one is when the quantum is large or difficult to compute. When we look at COVID insurance claims, these claims have had the elements of both, okay? And I'm going to go through a couple of them. The first key issue is what insurers have been raising as one of their defenses, being that the policy was not designed to cater for such a circumstance. What insurers are saying is that the infectious and contagious extension in policies was there to cover localized outbreaks or incidents and not that on a national or global scale, all right? Then how does one prove a case of infection? And I'm going to talk a little bit about that shortly, because we know that initially, if you've lodged claims with and contact was made with you by the insurer directly or via a loss adjuster, you would have seen a wish list from then. And it's not surprising if you were scratching your head wondering, how are you going to get all this information that they requested, which included the names of the infected persons, the date that they went to hospital, etc., etc. Then where a client or insured has had infections on their premises, meaning a staff member, for example, had it, or where, for example, if you were in the hospitality industry and a guest stayed at your establishment and had it, it shouldn't be too difficult to get the policy triggered and to calculate the loss for the period that there was a forced shutdown in order to allow you to do a deep cleanse or decontamination process. However, what we are finding is that the majority of our clients have had losses that have come about more from the lockdown and people's and businesses' inability to conduct business as usual. Then, how does one draw a causal link between the infection cases and the business's reduction in turnover and losses? And how does one calculate losses directly attributable to the infections and separate it from losses attributable to the restrictions of businesses and entities' inability to conduct business as usual? Right, so as Marsh, needless to say, we've been engaging extensively with insurers, we've been liaising with loss adjusters, and we've been advocating quite tirelessly to put our clients' best claim forward and for insurers to consider it favorably. But at the same time, insurers, with guidance from attorneys and their loss adjusters, have also been raising their own defenses. So with the industry having no precedents to fall back on, the last time we've had an outbreak of this scale was in the early 1900s. And, you know, at this point, we don't really have much precedent set. So this is where the Financial Services Conduct Authority has had to step in. The FSCA has consistently indicated that it agrees with insurers that the lockdown is not the trigger to the policy. There must be an infection on the client's premises or within a certain radial limit as stipulated in the policy. The FSCA has also agreed that there must be a causal link established between these losses, between these infection cases and the losses that are being claimed for. As I mentioned earlier, one area that the FSCA has shed some clarity on and assisted is in terms of the requirements to prove infection cases. And in one of their correspondence, the FSCA did indicate to insurers what would be deemed reasonable, because insurers' initial stance was infringing on patients' confidentiality and privacy rights. The most recent correspondence from the FSCA indicates that where a client has submitted a claim, no insurer can reject that claim on the basis of the lockdown. So where does this all leave us? At the moment, we've been submitting insurers' claims and giving insured's claims and giving guidance where required. But ultimately, we find that insurers that have been taking the stance of not making any decision in the interim and waiting for the outcome of various court actions that are underway. I'm going to talk a little bit about three of them. If we firstly look at what is happening in the UK, their version of the Financial Services Conduct Authority is what they call just the FCA, the Financial Conduct Authority. This is a business interruption trial case where the FCA has brought the action on behalf of all policyholders, and 8 insurers are being challenged. The courts have been asked to adjudicate on the issue of liability, should insurers be on the hook based on the various policy wordings that are being considered, and then if so, how does one go about quantifying such a claim? Interestingly enough, this matter is now concluded, and tomorrow the verdict or the judgment is going to be announced. So we're quite eagerly awaiting that, as we expect that there will be a global ripple effect from that decision. And one would also have to wait and see, as there may very well be an appeal by the party whom the courts rule against. Then if we bring the matter locally, something that's been in the news quite a lot and is quite topical at the moment is the Cafe Chameleon and Guard Risk matter, which has now been taken on appeal, and we expect it's going to be heard in the High Court on the 16th of November. And then the last one, and this one is quite recent, it is the Mar Africa Hotel Group taking on Santam. And this is expected to set precedent for all hospitality clients. And this is currently underway in the Western Cape High Court, and it got underway last week. There may be a couple more weeks to go until this is finalized. And once again, with both these matters that I've mentioned, there may well be further appeals. Nobu, next slide, please. In the interim, there's been numerous discussions between the FSCA and the insurers, and a decision was reached that whilst certainty is awaited from the courts, and we do know that this may go on for a couple more months, insurers are being stretched to the max, and we know cash flow is under pressure. So the FSCA has struck an arrangement with the insurers for them to offer relief payment options to their insureds. These have been mainly directed to small and medium enterprises, and mainly those in the hospitality industry. The intention behind this is to provide some temporary assistance and relief until finalization is achieved in the courts. What this does entail is that if the courts rule in the favor of the insured, then the insurers have said there won't be any clawback. However, if the courts rule in the favor of the insurer, then the relief payments will be set off against, sorry, I may have mixed that up. Then the relief payments will be set off against the final claim settlement amounts. The different insurers have been taking different approaches. Some have been applying a maximum amount or a cap on their settlements. Some have been saying that they would be looking at 2 months of losses. Others have been saying they'll cover further months, but at 60%. The only difference that we found is mainly with Old Mutual Insure, who have structured theirs not as an interim relief payment, but rather as a full and final settlement, meaning that once the insurer signs whatever offer is proposed, then there's no further recourse to any further legal action or any other action for that matter. All right. Nobu?
Great, Nolan, thank you so much for that update. Very interesting. I think ultimately a lot of these matters are going to go on appeal. I think they're going to go to the Constitutional Court, and so I don't think we're going to see resolution anytime soon, but at least we are making some progress. So I'm going to take you through a FinPro overview, and I'm going to do it quite quickly because I'd really like to get to Jane on the rest of the market. So thank you, Nobu, if you can take us to the next slide. So I just really want to touch on financial institutions and the state of the market. And when we talk about financial institutions here, we talk about insurance for our banks, for our asset managers, for our large insurance companies and the like. And of course, we reference commercial crime, civil liability, and directors and officers liability for financial institutions. And I think it's important to understand how insurers view financial institutions, as they are, of course, central to this whole concept of coronanomics, and all eyes are going to be on them in how they bring stability back to our financial markets. So just to give you an overview and a flavor, globally pricing for financial institutions rose 26% in Q1 of 2020 and 37% in Q2. So you can see that the trend is still trending upwards, and that was versus an 18% in Q4 of 2019. The UK market saw the greatest increase, with 46% on average increase, compared to the US at 23%, which is quite interesting considering the US normally leads the charge. In South Africa, we look after 3 of the big 4 banks. Not everyone has had their renewals, but those that have certainly experienced double digits, and fortunately nowhere near the sort of 37% that we're seeing in the London market. From a risk perspective, I think what insurers are particularly worried about in the banks is when they see any changes, of course, to credit practices. They are extremely worried about cyber risk, and we only need to consider the likes of Experian and some of the other cyber risks and cyber breaches that we've had in recent times. Cyber is definitely the #1 risk on everybody's lips, and you will see that across the classes of insurance, a lot of additional questions being asked around how companies have managed and mitigated the whole COVID experience, and of course how they are managing and mitigating cyber. Within cyber, we're seeing already some of the premiums start to go up, and that was one class of insurance that used to be quite benign. Insurers are also concerned about social engineering and, of course, impersonation fraud, especially during these difficult times. From an insurance company perspective, insurers are, of course, worried about those class actions that might well be forthcoming for wrongful denial of coverage, specifically what Nolan has been speaking to. And, one considers the likes of Santam and Guard Risk, and whether class actions are forthcoming against some of these insurance companies. From a pure market perspective, market conditions, we are seeing, as we are across the board, premiums are up, capacity is down. Excess markets are no longer following the leads rating. They are simply charging what they want for the risk. Deductibles are exponentially up and dramatically up, and are forcing a lot of our financial institutions to consider things like self-funding structures, which Matthew is going to touch on. A lot less flexibility around broadening of coverage. We are seeing lots of new exclusionary language coming onto these wordings, and far more stringent underwriting criteria. So risks are taking a lot longer to renew. You can move on to the next slide, Norwood. So if we think financial institutions are bad, this is really where I'm having to tint my hair every couple of weeks even more, and that is if you look at D&O. This is a slide on our FTSE 100 companies, and you can see in Q1 2020, your average rate movement was up 170%. The D&O train is in full speed, and unfortunately no signs of slowing down anytime soon. We have seen significant increases across the board, and many organizations experiencing hikes of well over 100%. Norbu, on the next slide. Thank you. So just to summarize the state of the D&O market, there is simply no new capital coming into the market, and therefore we have a capacity crisis. We have already seen at least 5 markets in the London market simply close up shop and pull out of writing commercial D&O, and that has set us back around $50 million in capacity. So you can see the crisis with no new capital coming in. Triple-digit premium increases are not uncommon, particularly where clients have had claims, and of course in those hard-hit industries, like in the airline industry, like in the pharma industry, and of course in the hospitality industry. So it's difficult to sell a triple-digit premium increase, but unfortunately we are seeing it. We are not like Tesla, who decided, of course, last year simply not to renew their D&O. They said it was simply too expensive. This year, I see that they now are back in the market to renew their D&O, and markets are considering it, albeit with a CEO exclusion for Elon Musk. And that really talks to the exclusionary language that we're seeing in the market. It looks like Insurers are wanting to go back in time. We are seeing things like insolvency exclusions. We are certainly seeing COVID-related exclusions. We are even seeing things like insured versus insured and major shareholder exclusions working their way back into D&O language, which is something, as I say, we saw maybe a decade ago. So the market is really, really regressing. Significant appetite restrictions. So where insurers are writing the risk, they are significantly reducing their capacity. Some insurers not wanting to write more than a $2 or even a $5 million line. And that, of course, creates huge havoc when you're trying to build a program, for example, of $100 million. What we have seen as a result of the significant appetite restrictions is that many of our clients, in fact, have not been able to renew their full limits. We had a number of examples of clients buying around $100 million, even $150 million, and only being able to secure $50 or even $20 million in capacity. So very, very, very worrying state of affairs. Again, we've got to manage that capacity as best as we can, but I think the most important thing that we're seeing in the D&O, what's leading the D&O change, is this change in litigation and regulatory landscape. And Nobu, if you just take us to the next slide, I think what's becoming critical, and I'm going to focus on this slide on shareholder or what we call stakeholder activism. I think what's absolutely becoming critical as a result of COVID is it has definitely ushered in a new way of corporate thinking. We call it coronanomics, and I think it is absolutely clear that profit is no longer the major concern. You know, it is no longer profit at all costs. It really is about value creation in all its forms. It is about that integrated thinking and integrated way of doing business that King 4 advocates, you know, and we were ahead of our time when we designed King 4 and spoke about this integrated thinking. So there's no question that boards of directors are going to have to think differently, they're going to have to plan differently, and they are going to have to act differently. We are going to see stakeholder activism like we have never seen it before, the longer that this corona goes on. And it simply says that, as I said earlier, no longer is profit at all costs. The corporation now has far more responsibility to its greater stakeholder base. And really, we only have to look at the likes of the recent Clicks Matter, Black Lives Matter, the hashtag #MeToo Matter, and climate change to realize that stakeholder activism is on the rise and that reputational risk has never, ever been more important. And all of this, of course, is going to culminate into how boards will manage and mitigate their key exposures and, of course, their key personal risk when making judgment calls. We talk about the business judgment rule, and I think the business judgment rule for 21st century post-coronanomics is going to receive a lot of airtime. And when directors are making those very important judgment calls, you know, as to whether to delist a company, to sell off a company, to close a subsidiary, to raise capital, to list a company, they are going to have to look to the business judgment rule more carefully than they have ever done before. I want to just mention that it's not that Corona has not brought claims, it certainly has. In the US to date, we have seen 16 securities class actions already raised. Some of you will be familiar with the Norwegian cruise liner, which was one of the first claims to arise. And this was a claim against the CEO and CSO for misrepresentation, for making or providing false information to entice people to buy their cruises, and of course, thereby endangering the lives of customers. And this was right at the start of COVID. We had Invio Pharma. This was a US company who promised a vaccine within 3 hours, not days, hours, once they had the DNA sequence of the virus. Of course, that wasn't true. Their shares rallied. Once the truth came out, their shares halved, and so a securities class action followed. And then another interesting one is the Phoenix Tree Holdings matter. This is actually a Chinese company that sought to list via an IPO on the New York Stock Exchange. Of course, in its prospectus, didn't mention anything about the fact that there was coronavirus in China at the time, and this was in January 2020, and they are now being sued again for misrepresentation around the coronavirus. So lots on the go with respect to that. Next slide, please. At home, I just thought I'd mention that there have been some developments at home from a directors and officers perspective, two very important judgments. The first being Brain versus Steinhoff and other, and Glumisa versus African Bank. The African Bank matter has been taken on appeal to the Constitutional Court, and so hopefully we will get some clarity eventually around the interpretation of some of the sections in our Companies Act, particularly section 218, which is the section that talks about civil damages. So what the court in both of these cases, interestingly, has held is that directors owe fiduciary duties to the company and not to shareholders. And that's very, very important, because there is a governance thought, school of thought out there that says that we are moving away from directors owing their fiduciary duties to the company, and in fact now owing their fiduciary duties to shareholders and other stakeholders. Our law in South Africa does not say that. In both of these matters, shareholders brought an action against the directors and officers for loss of share value as a result of their wrongful acts, breach of duty, breach of trust, fraud, neglect, and so on and so forth. In both actions, the court ruled that in fact the loss of share value is not the loss of the shareholder, it is the loss of the company. And that's very important. It's what we call the reflective loss principle. And both courts concluded that it is the company that must claim that loss against the directors for wrongful acts. Shareholders can in fact utilize the derivative action under section 165 of our Companies Act. And so if a shareholder wants to sue directors in their personal capacities as a result of their share value being decimated, then they are going to have to use the derivative action, which of course is an order ordering the company to sue the directors in the name of the company. The other thing that the courts have said very importantly is that section 218 which is that all-important section around civil damages, in other words, suing directors for civil damages for breach of any section of the Companies Act. The courts have said that 218 does not alter the common law and therefore does not allow for a reflective loss claim to be brought under the section. Now, this is very, very important, and I think it's vital that not only clients, insureds, but also insurers take note of these two important judgments, because they really are going to set the scene for D&O claims going forward. Thanks, Nobelelu. Right, so I know that that was short and sweet, but as I said, I really want to get to Jane's talk. And I think before we do that, if you don't mind, leading into Jane's talk, just to give Jane a sense of how everybody is doing, if you could please answer the following questions on our live poll, and that is, have you had a premium increase of over 20% in your last renewal? I'm interested to see if you can take that live poll. Wow, look at that, look at that. Great. Good. So certainly what I'm seeing is around 58 to 60% of people are saying that they have had an increase of over 20%, and 43% are saying no. So I think, Jane, that's really, really interesting, and maybe you can unpack that when you go through your presentation. Right, so we've ended at 61% have said yes, they've had an increase of over 20%, and 39% have said no. So yeah, Jane, I think over to you to unpack that a little bit more.
Thanks, Terry, and good morning, everybody. If we could just move on with the slides. I could talk about this all day because I live and breathe it every day, but I won't. I will try and be brief, and we can take questions at the end. So I'm going to highlight property casualty, both the local and in the international market. I head a placement for Marsh, South Africa. So we are in the market every day, living and breathing this, and sometimes almost not breathing. So if we could move on to the next slide. Thank you. So this is just our consolidated global stats. I think Terry has spoken about the FinPro lines. showing increases in Q2 2020 of 37%. And obviously that's across all lines. As we've seen, the D&O has been much harder hit. Looking on the left at property, we can see the international market started transitioning rapidly in Q3 2019. And we've seen in Q2 2020 increases on average of 19%. Just for your information, these stats do exclude outliers. And in terms of outliers, we've seen increases of 150% on some. So what has happened here is what we've been experiencing this in the South African market for a bit longer. As you know, 2017, I think, was a horrific year for insurers in terms of property losses. There were a number of big losses, including the Knysna fires at the time, a couple of big significant fires, and our market actually started transitioning in 2018. We are seeing an impact on the international market. We access the international market for our clients as well, but this is also having an impact, and I'll talk a bit later, on our local market. Just high level global casualty starting to transition. That's mainly your liability lines, third party liability. And that's ticked up quite a lot in Q2 2020. From a South African perspective, we saw the July renewals. There was a rapid transitioning in the market. So this has an overall impact, but property is, shall I say, our biggest headache at the moment. If we could move on to the next slide, please. Okay, so from a South African perspective, we've seen significant increases on renewals, similar to the 19% average experience internationally, and this is often on the back of prior year increases. We're still seeing a reduction in capacity offered by insurers, so the amount of capacity they will deploy on a risk. There's still upward pressure on deductibles, the amount that a client will retain. We are seeing, especially on punitive deductibles, where opportunities for improvement have not been actioned. So if there's outstanding risk recommendations that haven't been addressed, insurers are now putting on significant punitive deductibles. Sometimes you will become your own co-insurer. If there's a fire recommendation outstanding, you may have to bear 10 to 20% of the loss yourself. The impact on the international market, other than us interacting with them directly, facultative reinsurance is very scarce on high hazard occupancies. Now, this is where an insurer buys reinsurance on a specific risk. Obviously, they're looking to protect where on the more difficult risks. In some instances, they just can't find it. Others, it is actually really driving their pricing and the capacity. If they can't get the reinsurance, they're going to offer less capacity. And often what we see is they will have a rate in their mind. By the time they've gone out and bought whatever reinsurance they need, that rate increases significantly. So this has added another layer onto an already difficult market locally. Insurers focus globally, and South Africa remains on profitability, not premium growth. Everybody's looking to improve their profitability. Nobody is looking to write that risk that is a little bit difficult and exposing their book. It's easier for them to say no, and I'll talk a little bit later how we can change that. And markets will walk away if there's no commitment and definitive action on risk improvements. We've seen in a soft market, questions don't really get asked around this. Some clients have kept it up, the economy's been tough, haven't. And now insurers will give you a year. If you're not doing it, we would rather not write your risk. So it is becoming, a lot of it is the focus on your own risk management within your company. I'm just going to touch on the next slide on the casualty market, which is your liability market. So as I said, we're seeing this transitioning rapidly. So what has happened here is, being a liability class, you've got a long tail nature of claims. You may do something now that you will only see the claim in a number of years' time. Also, courts are awarding higher and higher increases, and there's more litigation going on. So while I wrote the risk 3 years ago, I may only have the claim this year. Medical malpractice is an area where we are seeing a significant increase in claims and the awards. And there, obviously, where you're talking about minors, those can go on for years. So we've seen significant premium increases on recent renewals. Suddenly it's about, well, I'm putting out a big limit and I'm getting a relatively small premium. Even on the excess layers, which are not your primary, which is your bottom layer, we are seeing people being a lot more cautious. and they're often asking for multiples of expiring premium. We are seeing a lot of reduction in capacity from expiring markets. In some instances, we've seen that as up to 50% reduction. Suddenly you've got a 50% hole in your program you've got to fill. And international markets have a limited appetite for South African business. There's a perceived lack of risk management, sustained soft market, sometimes drives certain behavior. Now they're saying, oh, do we really know our risk? Are we really understanding it? What we haven't seen for a long time on liability is a lot of additional underwriting information. Insurers want to understand the risk and rate their exposure. So be prepared for that. It's not just, here's the turnover, here's the number of employees, this is what we do, and let's get the terms. So we will be engaging with our clients on that, and it is worth giving, because if you don't give the level of information the insurers require, they will either walk away or they will charge for what they don't know, and it has a significant impact on, they'll assume the worst, it'll have a significant impact on your premium. And again, it's focused on returning the book to profitability. They're not looking for growth. So they're under no pressure to write new risks or to renew existing risks. Thanks, Noba. If we could move to the next slide. So what is driving the sudden shift? I think what we see, this is the insurance market cycle. It's always depicted as a nice little wheel that goes round and round, and we know it doesn't really happen like that in reality. So in a soft market where everyone's making money, you see increased capacity coming in, increased capital coming into the market, which drives competition. How do you get new business? By reducing rates and premiums, giving broader coverage, going for lower deductibles. So what happens over time is then there's less premium to pay for claims. Because of the lower retention levels by clients, more claims are going into the market. So we see a decrease in underwriting profits. This can, and this is a longer term impact, is a decrease in solvency margins of insurers and their financial results. Then they suddenly start looking at claims, very sensitive. You know, they haven't got enough money in the bank for that big loss coming through in terms of their cash flow. So what we see is they will look at certain lines of business. As Terry said, a lot of insurers have withdrawn from the D&O market. We're seeing a number of insurers internationally withdrawing from the property market. What we are seeing more is a reduction in capacity they will deploy and selectivity. So they will look at their book. Cold storage has impacted on the markets internationally significantly. We've seen significant mining losses as well as others. So what they will say is, I'm no longer going to write any risk with cold storage because that's driving my losses, or with mining. So we see they become more selective and withdraw from certain portfolios. Suddenly there's less competition for those portfolios, so that will drive the rate. Insurers can charge more, as well as their own internal pressures. There's not as much competition externally. We will then see a reduction in coverage. I mean, COVID-19, we're seeing everyone putting exclusions on at the moment, as well as multiple other reductions in sublimits, but they are very cautious about that. Capacity is reducing, and they're forcing clients to take more retention themselves. Over time, this should drive profitability with a bit of luck as well. Then we start seeing new capacity coming into the market, and the whole cycle starts again. There's more competition and that. But what we tend to see is the right-hand side does tend to move quite slowly. When the market shifts upwards, in the upward trend, it shifts significantly. It's not a nice little wheel that goes round. It's pretty much a knee-jerk reaction, which I think even before COVID, we were in that cycle already. COVID is going to overlay another level. Nolan has spoken about the litigation going on. The outcome of that is going to drive, everybody is reserving for these losses. Are they going to end up paying them is what remains to be seen. So if we could move on to the next slide. So it's all about the balance between supply and demand. Soft market, oversupply of capacity, people are competing for business. Hard market, capacity reduces. And pricing goes up. And for our clients, it's working with them to balance the needs of what they need is from their insurance portfolio and managing the pricing. Nobody's going to thank you. It's easy to save money by stripping out a whole lot of cover, buying lower limits, taking significant retentions. No one's going to thank you for saving a relatively small amount if you're exposing the company to a large amount that nobody's really aware of. So you really need to think about this, and it needs to be an educated decision with the support of your board. So how can we help you in this market? If we can move on to the next slide. Unfortunately, there is no silver bullet. As we've said, probably for the past 20 years, other than some occupancies like mining, we have had market cycles in between. We've seen an oversupply of capacity, there's strong competition, all these extensions are thrown in, and it's very easy to place business. Currently, the international market is transitioning. I would say the South African market is still transitioning, but is already very difficult and hard. So we're seeing with the reductions in capacity, as we said, pricing increases, significant increase in data and analysis required to support placements. So insurers won't just believe us, they want to look at it. They've got sign off internally. Underwriting is no longer left to the underwriter. They have to refer things. Often there's international referrers, becomes underwriting by committee, which increases the time before they are able to give us terms. So first of all, they've got to review all the information, ask additional questions. Often their surveyors will have to look at the risk information before they're even allowed to quote. Then there's the internal referrals. So all this is taking a lot longer. And then they'll come back with their pricing and their increased retentions and co-insurance requirements. So what are the strategies? Start early. That is the biggest thing. You don't want to be the risk in the market running around in the last few days trying to fill that last 20%. Markets become opportunistic. They realize you're stuck. They'll put out a price that is multiples of any other price because they know you're desperate, and you will have very little option. So keeping control and managing the process is critical in this market. We need to identify risk appetite up front. Let's not let the insurers drive the risk retention conversation. Let's drive it for ourselves. What could we retain if we have to? It's not necessarily saying we're going in the market first time, but we know that that is an alternative for us and what we can do. Information is key, and the perception of the risk and the high quality underwriting submission. So presenting, making the underwriter's job easy, presenting in a concise format, dealing with the issues. You know what, if we've got ISO paneling, which is everyone hates in the market at the moment, yes, we do have, but this is how we manage it. If it's sprinklered, what are we doing, what we've done? Risk improvements are critical. That ties into it. Yes, we know our risk's not perfect, but we've done all this and we still plan to do this. Make the insurer's job easy, give them the information, show them the as-ifs. So, you know, going into the market with piecemeal information, we don't really know, multiple rounds, insurers are really busy at the moment. The underwriters, it's easier for them to say no, and they're not going to get criticized for saying no. So it's about us making their jobs easy, being able to articulate what we're doing, working with our clients. And Marsh do work very well, and we get good feedback from the market that we do provide these quality submissions, but it's just keeping ahead of it. You know, hitting on the real issues, being short, concise, as I say, making it easy for them. If we have had claims, what have we learned? You know, we need to be able to articulate that. And they will be very interested in that. Claims management protocols, we need to engage with our international hubs. How do we know if we've got the best result? We've looked everywhere. Involving C-suite, especially as Terry said for the D&O, often a cross-class lens. So if we blend the D&O, potentially the crime, the liability, if we approach an insurer on all those classes, it can help them be more competitive on the more difficult if they've got supporting business. Doesn't work all the time, but it's something worth looking at, and sticking to agreed milestones to keep control. There's nothing worse than being there short at the last minute. So it's really about working with our clients, getting the information through, positioning the risk in the best possible light, being able to answer questions, and us managing the conversations and the timelines. Thank you, Terry.
Thank you, Jane. I know a lot to process and a lot to get through. And I just want to emphasize what Jane is saying on the D&O is just start early, and start early. and it always still somehow comes down to the wire. Please continue to ask your questions on the Q&A button. In the meantime, I'm going to hand over to Matthew because I do want some time for questions, and I see we're already at 1:45. So Matthew, if you want to go ahead on the on your talk. Thank you.
Sure. Thanks, Terry, and good morning, everyone. So I'm Matthew Bezadnote. I'm the Marsh Advanced Risk Solutions Practice Leader, and that encapsulates risk finance and captives here in South Africa, but we're also a global practice. I'll be moving quite quickly to go through, so we leave that time for some questions, so please brace yourself. What do we do in risk finance? Essentially, we help our clients assess the optimal point between retention and transfer. And we have a host of services around this to help our clients understand, how much they should be retaining in-house and how much should be transferred over to insurance risk. What is the cost-benefit analysis of that? And then we provide solutions in the actual space of structuring for our clients as well. So maybe to quickly go through this definition, and then I'll touch on why this is important in the hard market. Risk finance is the determination of how an organization can finance loss events in the most efficient and cost-effective way, or least costly way. Now, in simple terms, that's really budgeting and providing for loss events. And in my next slide, I'll expand upon that. This then takes into account the balance between the risk transfer and retention through use of available risk management mechanisms. And I've mentioned risk management mechanisms as per the below. So conventional insurance, where you're simply contractually transferring a pure risk to another party, and that would be your insurance. Then there's captive insurance that can be considered, which is a separately incorporated entity, an insurer in its own right that insures the risks of the parent and affiliates. And then there's formal retention on balance sheet. So you can formally retain the risk on your balance sheet as well via a structure and ring-fenced funds for that risk. Informal retention, simply retaining the risk in-house, but not necessarily providing it. And then other structures. So other structures that help you to retain risk in-house, which is an example would be a contingency policy, which is essentially an insurance policy that allows for you to participate in underwriting profits and in the good experience of your own claims. So an experience account is set up into which premiums are paid, out of which claims are paid, and you accrue the investment profits and the good experience of the account as the insured. It's your money and your funds, and that can be paid out as a performance bonus, for instance. But there's a whole bunch of other structures that play in this space as well. So spread loss policies, which provide additional cover from day one, through to cell captives, and I'll briefly touch on those in the next slide as well. What do we do while we look at this risk finance optimization? We take into account the willingness of the organization to take on risk, as well as the ability to do so. So that really speaks to risk-bearing capacity and appetite, and I'll touch on that further in the next slide as well. Altogether, risk finance really needs to take into account the organization's risk profile, their financial position, the operational environment, and whether or not it makes sense to retain risk in-house. Now, while this is particularly relevant for today's discussion, you heard earlier as Terry and Jane commented, the market is hardened. It looks like it's going to ensue for some period of time. And really, I think the days are past of simply just transferring risk away. You really have to look at the retention function as well. So risk finance provides an alternative to transfer. And when you're starting to experience these low capacity scenarios, high deductibles, it allows you to bring more risk in-house in a structured format via a mechanism that's similarly structured to insurance in many instances. And taking that risk in-house, first and foremost, allows you to build capacity for that deductible layer that you may want to buy up in future or forced to essentially service. It also proves to insurers that you now have a vested interest in the same risk that they are insuring, and that their bad experience is also going to be your bad experience in the first instance. So really having that skin in the game provides additional, how can I say, the scenario of perhaps being able to better negotiate your risk as well, then your bargaining power is also enhanced by being able to directly access the reinsurance markets through some of these structures too. So that gives you another option to put risk into the market. If we can please move to the next slide, Noble. So I'm very quickly going to light touch on this whole process here. This is our risk finance optimization process. And I think the reason I want to put this forward today is that it helps to contextualize how you approach risk and how you approach retention. And that will help to provide an overview of the whole landscape, essentially, of how this should be approached. So in the first instance, we help determine risk appetite. And that really is a capacity and a tolerance statement. So how much can you actually retain in terms of risk, and how much would you look to retain as your tolerance limits, which takes into account KPIs and various other factors. From there, once we know how much you want to retain, or you are able to retain and book according to your appetite, we then move to measuring business risk, because business risk is going to be one part of the puzzle. So those business risks that cannot be insured, and as well as step 3, where you measure your insurance risks, those form your overall risk sort of environment. And those will both be a draw on your risk appetite. So you have to consider both of these together. Once you've assessed business risk, and this isn't always assessed because it can be quite a complex exercise, we then move to measuring insurance risk exposure. And that's forecasting your losses. So the specific losses you might be occurring in future according to actuarial probabilities. So how often they're going to happen on a frequency basis, and what the severity is. And then we plot those various probabilities to enable you to understand, if I take more risk in-house, how is this going to affect me? How is this potentially going to affect me? We then marry all of those scenarios and allocating that risk appetite to insurance risk. So how much more risk are we going to take on the book? How much more are we going to raise that deductible? And then we start looking at the various options in the market. So when the market comes back with options at step 5, we then take a look at which options present the lowest total cost of risk or economic cost of risk. And there's a small distinction. In the interest of time, I won't speak to that distinction. But really the two drivers are, what is your insurance premium pay away? And then at the same time, what is the additional perceived risk that you're going to retain on your book and have to pay for? And you try and balance those two factors to get your smallest cost of risk that you can. So we'll actually do the option testing from the market and see which one makes the most sense when you look at the whole spectrum, instead of just looking at what you're paying away and what you're covering. And then from that step onwards, there's risk financing. So looking at the actual appropriate structure to house these risks. And these all vary depending on the amount of risk that is on the books. So what does the risk program actually look like? How big is the insurance program? The nature of the entity and the nature of the operating environment, and scale to a large degree, starting from low scale and contingency through to cell, through to captive. And happy to take more questions. So please, you'll get my contact details. It has been a bit of a push. I'll hand it back over to Terry at this point. Thanks, Terry. I hope I don't sound like a race course commentator there.
No, thank you. Thank you. I mean, it's quite a process, you know, the whole risk finance optimization, it really is a process. Please, if any of you are interested, reach out either to Matthew or to your usual Marsh contact, you know, and I'm sure Matthew would be happy to meet with you guys and take you through it. Just before we go to the questions, we are going to have another quick live poll. Our next topic is going to be total cost of risk, but of course we want to ensure that topics that we cover are interesting and things that you want to focus on. So if you can, please just answer this poll, which themes most interest you: reducing total cost of risk, understanding changing risks, building resilient businesses, harnessing collaborative technology, alternative risk transfer, delve a little bit deeper into that, and then of course prioritizing our health. Whilst we are waiting for those surveys, One thing that I do want to just introduce or flag, I mean, it comes from what Jane has said, and that is around risk management and the focus on risk management, particularly enterprise risk management. So I want to introduce you to our app, and in particular, our Oliver Wyman app. Our Oliver Wyman app is called Ideas. I'm going to try and show it to you if I can. I don't know if you can see that, but it's the black app over there. It's called Ideas. It's a black and white app. Go on to your app store, download the Oliver Wyman Ideas app. It is really a wealth of information with all sorts of enterprise risk management topics, from pandemics to banking institutions and everything in between. So please go ahead and download that app for free and enjoy the content. I see that our poll is up and 35% are saying reducing total cost of risk. So that's really obviously very important. 19% at understanding changing risks, building resilient businesses at 14%, harnessing collaborative technology at 9%, and alternative risk transfer at 21%. So I think, Matthew, certainly the next talk you should elaborate on what you've done. Right, I think that really there is one more poll. I'm just going to share those results. There we go. There's just one more poll. If any of you would like a Marsh consultant to contact you on your chosen theme, please answer yes or no. And we will, those who are answered yes, of course, we will make sure that a consultant contacts you. I know that we have run out of time insofar as presentations are concerned, but I really do want to have some time for questions. Of course, if you have any other concerns, please do ask us or email marketingafrica@marsh.com. And they will, of course, also make sure that your client executive contacts you to get hold of you. And finally, please visit our Corona Resource Center on marsh.com, where we will be uploading material that you can use to give more information around the state of the market and similar topics. So thank you for that poll. Very quickly, we are going to look at the Q&A. I see there's a question from Antonella. She's saying some policies are only for increased cost of working, and in the early days, there were no tests conducted on people that fell ill. Some getting ill in late February and March. Interesting was insurers endorsing policies with cancellation of cover effective in May. The insured is required to prove that they were tested and were positive, but we all know that these tests were only available by the NICD in March. Essentially, this is a chicken and egg scenario. And insurers denying liability on proof of loss is a bit premature. Nolan, perhaps you want to comment on that.
Yes, Terry, thank you. So I think what Antonella has put there is more of an observation than a question, and one that I would agree with. It does create a conundrum which doesn't quite make sense. In this regard, I would say that there would be valid grounds to challenge the insurer in such a decision.
Great. And I see the other question from Nobelelo is how many claims have been intimated by clients at Marsh for COVID claims?
I've looked at the stats, which I last received from about a week and a bit ago, and we're sitting at around the 1,000 mark, 1,000.
Wow. Okay.
Mainly business interruption, a couple travel, a couple other classes, but mainly business interruption.
Okay. Excellent. Any other questions? Let's see. I think we've got one more. What is the main advantage of captives? Matthew, over to you.
Hi, sure. So thank you for the question, Azir. The advantage of captives, I mean, it's ultimately about reducing total cost of risk and capturing any underwriting profit as well as investment returns. And that can be in a captive, a cell captive, or contingency policy. If your question is relating more to what the advantage of a captive is, the advantage of a captive over a cell or a contingency, for example, would be that you have separately incorporated that entity to specifically ensure the risks of the parent. So it's a highly bespoke offering that can be put down. Those policy wordings can be fully worded to meet the requirements of the entity. And you have a lot of autonomy because essentially they're catering to the needs of the parent. So there's a lot of autonomy in the way you can operate, what you can invest your funds in. And yeah, essentially those are the main advantages, I would say.
Are there any tax advantages? Because I know at one stage there were, but have those been sort of closed, those tax loopholes?
So much, because there's a component of risk transfer that's structured into the policies, Terry, there would be a tax advantage. So your premiums would be tax deductible in 99% of the instances. You just need to be able to show that there is transfer occurring. So that is a major advantage behind all of the structures.
Okay, and insofar as jurisdiction of the captives are concerned, onshore, offshore?
Sure. So you can also benefit from the favorable tax environments or domiciles that you may have overseas. So for example, an Isle of Man would have a tax rate of 0%, whereas we would be having 28% in country. You then just need to look at how your options are affected by the requirement for an in-country insurer to front the arrangements, essentially. But yes, there's multiple benefits to other domiciles as well.
Great. Thanks, Matthew. I don't see any other questions. There's still 60 participants online, so please feel free to ask another question. I think I'll wait another couple of seconds. I know we're slightly over. Maybe just a last question to Jane from me. Jane, I mean, we've spoken a lot about the hard market and the cycle, but when do we anticipate the cycle starting to turn? And do we think that COVID has been the catalyst to maybe
I think looking at a total international perspective, thanks Terry, we do not foresee the market turning soon. COVID, if it doesn't happen, I think will help us, but will not turn the market sort of softer again. Insurers need to return to profitability before we start seeing more appetite coming back. One or two markets that reacted early are starting to broaden their appetite. We've got treaty renewals. A lot of the treaties renew on 1 January, and we think those are going to be challenging. So I would say not for the next 12 to 18 months are we going to see a significant shift. Thank you.
Right, so absolutely essential to take note of those 10 bullet points that you had on your slide with preparing for renewals. Those are not going to change, and in fact, we need to pay extra attention. I think the last question I'm going to ask to Nolan and let him perhaps have the last word. Nolan, not holding you to this, but your view on what you think the final outcome on these BI claims from the courts are going to be.
Terry, thanks for putting me on the spot. I must be honest, I've been following the cases very closely along with my counterparts from the various countries, and it really is 50-50 at this point. Yes, there's been strong arguments raised in favor of the underdogs being the insured, but the insurers have also raised some very strong arguments. So one will just have to wait and see. But what I can say, once again, from discussions with my global counterparts, is that our South African clients have a good chance of something going their way purely because of the way that our wording has been designed. And also, if we look at particularly Marsh clients, if we look at Santam, they've indicated to us that the number of policies they have with the infectious and contagious diseases extension is 5% of that book, of which Marsh clients make up the majority. So, against that backdrop, let's wait and see. We're cautiously optimistic.
Good. I'd hate to be the judges that have to finally decide it.
Yes.
Ladies and gentlemen, thank you so much for joining us. It really, really is truly appreciated. I'm going to let you all go. I know it's busy Monday. Thank you so much again. You don't need to do anything. We will end the meeting for all of you, but please reach out to us if there are any concerns, any questions. We'd love to be able to help you, and have an excellent Monday, a great rest of the week, and go well and stay safe.